Hello, everyone. Today, we're going to try to do three things, I take it. The first one is to try to forecast the global financial landscape in 2024, but also remind ourselves to try to forecast a bit of Greece at the end of the day. Now, in order to make things a bit more interesting, my preference in this panels is to take questions from the audience, which I've been told that I can't because the infrastructure is not there. So the second best is that I have given permission to my three speakers to ask questions to each other. So hopefully we'll get ready for a little bit of an interesting interplay of ideas here. And the third thing that we're going to try to do is try to finish with, I don't know, 3 or 4 minutes to spare, so as to make sure that I have a Wikipedia entry that we actually finished earlier than planned. So with that, I'm not going to do the introductions of our three speakers because I think there's plenty of information on that, and I want to save time. But suffice it to say that these are folks that for a long time in their careers, they've either helped invest very large sums of money, or they have directly influenced people who are investing very large sums of money. So they're well trained to at least try to tackle some of my questions here. So I'm going to start with Nikos Panigirtzoglou, who is from JP Morgan. And I guess my first question to you, Nikos, is your description of your title is cross-asset strategist, so I'm going to use that, and ask you to describe for us a bit, as you're looking for the rest of 2024 at least, what is the background, the relevant background for you for the economy and the markets, and how does this influence your best idea, or best ideas rather, in terms of cross-asset allocation or portfolio allocation? So please.
Thank you, Yianos. Thank you for the invitation. Just disclaimer, whatever I say is my own personal opinion and not JP Morgan's view. I think we are in a very problematic backdrop for markets, for both equities and bonds, the two major asset classes. And there are three reasons for that. The market has been propelled by this immaculate disinflation thesis, the idea here that inflation would be going down with the economy staying strong, and that idea proves increasingly more problematic. We saw the CPI release yesterday, the previous two CPI releases as well. So it looks like inflation is popping up as a problem again, and that's not surprising. When you have an economy like the US economy, where payroll gains over the past 12 months are 250K, and over the past 3 months, 276K, that's surely above what we call neutral or non-inflationary payroll pace. So it's inevitable that with such strength in the US economy, inflation, and such strength in demand and labor markets, inflation will pop up. And we are seeing that already. It is true that rate markets have responded to that inflation, reemergence of inflation as a problem, but not equity markets so far. But again, that's not unusual for equity and bond markets to be out of sync. We saw that last summer. If you remember last summer, when inflation was popping up as a problem again, you had rate markets and bond yields moving up since May 2023. Up until the end of July, the equity market was not reacting at all to the rise in bond yields, and we had to wait until August for the equity market to react, and we had that correction from the end of July to the end of October, 10% correction in equity markets. So something like that could be happening in the current juncture, where rate markets have been adjusting to the reemergence of the inflation problem, and equity markets react with a lag. That's the risk going forward.
So what's the implication in terms of the investment or relative investment decisions here? at least with the horizon of the year?
Neither bonds nor equities are a good place to be.
Okay.
The most we envisage for equities as an upside that only if the Fed cuts rates in the summer, and that is a big if, because yesterday's CPI report naturally pushes the Fed into September, the first rate cut, and that is problematic because for many people, the interference of the November election, US election, is a problem for the Fed. If the Fed does not begin the rate cut cycle in June or July, then September is too late, and then we'll go to 2025. Neither equities or bonds are good places to be. As I said, the maximum we envisage for equities upside it's 5%, which is pretty much what you get on a money market fund. You get 5.25%. Commodities is a place we like because it's obviously an inflation hedge, in particular in the current juncture where supply constraints are pushing up commodity prices outside gold. Gold, not a good place to be. Very frothy, the backdrop, the position backdrop, similar frothy, I would argue, to Bitcoin. So there is a risk here that if we get an equity correction, and given the position backdrop, that equity correction will likely be bigger than the 10% correction we saw between the end of July and the end of October. There is a risk that gold actually goes down rather than up.
So in other words, you're optimistic, right? No, I'm just kidding. But all right, just I'm going to do the opposite that people do. We're talking about artificial intelligence, no? So I'm going to ask you to do the opposite. You, as a human intelligence, your pattern recognition here, maybe that will resonate with some of the people here. What does it look like? I mean, markets-wise, what's the relevant, I guess, the closest year you can put a reference to for people here?
I think 2022 and 2018, that were periods where both bond markets and equity markets were selling off in tandem. I'm not arguing here that we are in the same macro position in terms of policy or the economy as in 2022 or 2018. Perhaps 2018 is closer, but I think the big difference with all these previous cycles is that each cycle is unique. So I think it's dangerous and misleading to start looking for previous cycle similarities and saying, okay, these are the patterns we saw in 1966 or 1984 or 1987 or 1995 or 2018, which were the previous 5 non-recessionary Fed tightening cycles. They were all different. The big difference with all these previous 5 non-recessionary Fed tightening cycles is that in all of these 5 cycles, 1966, 84, 87, 95, and 2018, the Fed cut rates soon after the last Fed hike. 1 month after, in 1966, 1984, 1987, 5 months after 1995, and 6 months after 2018.
Yeah, I'm not going to tell you how many of those I actually lived in the markets, but I think for this audience, probably most of them will, remember 2022 in terms of what it might feel like. So I think that's very interesting. With that in mind, I'm going to move to Themos Fiotakis from Barclays. Themos, I'm going to ask you what do you disagree about, and I'm not going to put you on the spot, don't worry. I just wanted to think a little bit now in terms of the risks. And the right way, I think, to start is to start contemplating the known unknowns. The problem when you do that is that people might come with a list of 30 things. What are the most interesting known unknowns for you now for the rest of the year? And what do you make out of them in terms of how we should be thinking investment-wise?
Thank you, Yianos. Thank you for the invite, and thank you to the Delphi Economic Forum for hosting me again this year. I think that I have no disagreement with the short-term implications of the repricing of the story that Nikos is describing. I'd like to zoom out a little bit because I think there's 3 tectonic plates that are moving at the moment. They're moving slowly, but they're producing earthquakes in the financial landscape, and I think that they need to be identified. The first one is the US. A lot of people are observing the US as in the prism of cycles, the Fed, etc. The US for the last 20 years has applied policies of exceptionalism. Over the last 20 years, they have become a bigger producer of energy than OPEC. They have become a technological superpower, and the adoption of AI is exponentially accelerating at the moment. They have become a very favorable tax and capital allocation destination. They have attracted capital, produced higher returns on capital, and for the first time in decades, they're now introducing industrial policy. They're giving money to companies to produce out of the US, subsidies. This is something we hadn't seen in decades. The fact that the US economy remains a closed economy and overstimulated is not something that is happening by accident. It's by design, and it's forcing a lot of capital into the US economy. So I would think that even if there is wobbles, the US exceptionalism is not something that is going to be changing. In fact, it will be accelerating, and it will have implications. By the way, I know this is something that we have been discussing with Panagiotis too. They're not only becoming all of these superpowers. Ukraine is showing that the acceleration that the US is producing in the military space is parallel to no other country in the world. So in defense spending, they're becoming a sphere of their own. In the other side of the spectrum, China, that used to be 40% of growth of the economy outside of the US, is going through a crazy, unattainable experiment of gearing the economy around from what it used to be to something new. They are delevering very aggressively. They are penalizing a lot of the sectors that grew the economy, from tech to property investment, up until now, and they're driving a government-led investment plan of protectionism towards their industrial sector. What does that mean? Up until now, China was the construction hub of low value-added equipment for the industrial chain. They're increasingly under the ambition of replacing the entire production chain and becoming the entire production chain. So instead of doing the skeleton of the car, they will be producing the entire car. This is not something that is supposed to happen in the distant future. It's happening this year. They're pushing competitors away. They're gaining market share in other economies. That is deflationary, low growth for China, and intensely competitive for the rest of the world, which is causing a lot of reaction from the rest of the world. In the middle of this is the third tectonic plate, which is Europe. Europe is being hit by all directions, particularly in its core. Germany is going through a profound decline in its economic model of low energy security and high dependency on exports. Europe is 55% exports to GDP. They're reliant on exports at a time where both the US and China are promoting their own model in the expense of Europe. At the same time, high interest rates and other factors are causing slow growth into Europe. What does that all mean? I think that it's pretty clear that Europe needs to react to this, but they're not fast enough, and they haven't even identified the problem, particularly in the core of Europe, in Germany.
Right, but let me ask you, okay, how about the investors? All right, let's take everything in stride. What do? Is overweight the one, underweight the other, and just neutral on the third, or is it a bit more complex than that?
I think that, let me take it from where Nikos left it. Let's say that because of the Fed, because of inflation, there was a major repricing, major, I mean 15%, in the technological giants in the United States, the Magnificent Seven. I think that the trend is in one direction, basically. Let's say that we continue to experience energy shocks, like the one that Nico said. The US benefits, and the dollar benefits within that context, too. In contrast, what was a massive destination for investment for decades now, China, emerging markets, are now accelerating in disinvestment. People are removing money from those places. We haven't seen how that can produce a crisis. Let's see what the reverberation of that is. And lastly, Europe becomes the price taker For half of Europe, the core, the guys who were lucky for 20 years, this is a fundamental challenge. For Germany, for the North, this is a decade-long challenge until they change their business model.
So you're basically a step away from moving to the US, right?
Correct.
All right, let me come back to that. Now, Panagiotis Vlachopoulos is the CIO of Piraeus Bank. It's a very interesting experience, and we run into each other both in the US and in the UK over the course of the last 30 years. But you spend a lot of time with long-term investors. But before I go into that, right now you're sitting probably in one of the largest balance sheets in Greece. And we started the discussion with inflation, so I presume that you spend at least some time thinking about inflation. How does this affect your decision-making nowadays?
Well, thank you. Hello, everyone. Thank you for inviting me, and thank you very much, Delphi Economic Forum, for setting up an extraordinary set of meetings. Inflation is something that I have been looking into way before the 100-year pandemic or the invasion in Ukraine, because the structural reasons why we had so low and well-behaved inflation are turning upside down. Globalization is one of them. Themos mentioned China, but it was not just China, it was everything. Movement of capital, movement of workforce, favorable tax regimes, even for being...
Speak a bit louder if you don't mind. I don't think your microphone gives you enough.
Yeah, well, I can hear myself. I don't know, how about you?
You haven't surprised anyone yet. Come on, tell us.
All right. So I think inflation is going to stay volatile. That is, I'm more certain about the volatility of inflation rather than its absolute level or its trajectory for any point in time. But at the same time, I do not think that we're going to be going back to the disinflation problem that we have been having for so many years. So, and this is fueled by a lot of things, structural, the fiscal response that we had from a lot of governments, as well as geopolitics that we had been very lucky to not have as a big issue over the last 20 or 30 years. So inflation is going to be with us for some time, and it's going to go up and down. Earlier on, somebody was talking about negative prices in electricity. This is because the last 2 years we didn't have a winter in Europe, or in the rest of the world for that matter. But that's not going to be the case. So one needs to be very cognizant, needs to think out of the box. Any kind of relevant experience of the recent times is probably going to drive you to the wrong conclusions. And you need to study a little bit history to see what happens when we have so many disruptive moves at the same time, both geopolitical, economic, and the movement of power. In this environment, obviously, you need to have assets that are real in nature rather than nominal. And you need to also be able to sort of navigate through these high-frequency cycles that we have been not accustomed to as of late.
Panagiotis, sorry to interrupt you, but
Yep.
when we talk about real assets, most people would think of assets that you cannot really rebalance that easily.
Yeah.
Am I thinking of it the wrong way? Or what are those real assets that you would have a preference? And how do you rebalance in this volatile environment?
Right. So the core of it needs to be, as you say, non-rebalanceable, more structural types of exposure. Real estate is one. And this geography has some of it, and it's quite high quality, and it is right priced. And for the cycles, then you need equities, which are a real asset. But at the same time, you need to be cognizant about the valuations, the other confluences that you have from the explosion of technology and so on and so forth that is bringing a little bit of froth into the markets right now.
Just to interrupt you once more. So you gave us, though, the argumentation in kind of more longer-term moving factors. But for this year, it's 2024. I guess I'm going to try to give you the same type of question that I gave to Nikos. Pretend that you are ChatGPT. Which year does it feel like, investment-wise, 2024?
Right. For equities, it feels a lot like 1999, early 2000. We have a huge boom. We have a revolution. Back then it was internet. Now it is AI. But at the same time, this time around, we have another type of revolution, which is industrial in nature, and it's the green transition. Now, if we look a little bit more back, it feels a lot like the 70s, where we have a little bit more unrest around the world, and where everybody's becoming more introverted and less extrovert. That drives economic decisions.
I think looking at the average age here, I think they're going to focus on 99, 2000 at best.
I know.
But that's obviously very interesting. So let me just switch gears, because we threw a lot at each other in terms of how we look at the backdrop and the markets right now. But one of the priors that optimistic people like myself have is that, look, Greece is a special case. It's a special point in its business cycle. We have a good chance. I'm gonna start with Nikos. How do you view in this setup, and I know you don't particularly obviously look at Greece, but I think you can synthesize a view. How do you look at Greece and the Greek markets right about now?
Clearly, we had some positive news with the investment grade, regaining of the investment grade status that caused a rally in government bonds. The equity market has also been propelled by this, plus the anticipated upgrade to developed market status by equity index providers. All this is obviously happened or priced in, so that's largely behind us. Fundamentally, though, when I look at Greece as an economy, I mean, the stock market, I think, is a different thing. You could argue, well, the P multiple of the Greek stock market is around 8. For Mediterranean countries, is around 12. For MSCI Europe, is around 14. So it looks pretty cheap, like half of the P multiple of MSCI Europe. So I don't doubt that. To me, the worry is the growth potential of the Greek economy. And when I look at the growth rates, I feel disappointed because obviously Greece lost a quarter of its national income with the crisis. And if it grows at 2%, that's not good enough to recapture that gap. So it's lagging behind in terms of GDP per capita. I think it's one of the lowest in the EU, and that's a problem. I think for Greek companies, the problem is capital investment, capital deepening, capital per unit of labor, capital per unit of output is low in Greece. And we know that this is a significant source of productivity. You cannot have high potential growth and high productivity when capital deepening is not happening.
Right.
And Greece has benefited from the recovery fund. The recovery fund is going to end in 2027. What happens after that? Where is the money going to come from?
So look, I noted that you tried to be very polite here, but I'm going to make it sharper for you. It's, we have a repeat markets-wise of 2022, meaning a bad year for global equities, a bad year for global bonds. Would you think that in such a scenario you want to stay away from Greece? If you have to invest in Greece somehow, but you can have a dial from 0 to 100, what do you do with Greece?
Yeah, I think I fear that Greece is not one of these underweight markets at the moment. It's one of the markets that have been hot. So I don't think that if we have a correction in equity markets because of an inflation problem or some other reason, and that correction probably is going to be more than 10% because now the positioning backdrop is more frothy. I think Greece has that problem of having been a hot market is vulnerable to corrections.
Got it. Fair enough. So, Themos, you have put forward a theory last year about Greek growth. So I presume that you might have a bit of disagreement. Maybe not, I don't know. We haven't really talked about it, but I'm going to let you. What do you think of Greece right about now?
Yeah, so where I disagree, and you have heard me phrase this, and some of our friends here in the audience we have discussed this extensively. Where I disagree is I don't view the Greek economy historically as an economy that goes through these moderate growth cycles. Since the 40s, Greece has been a boom-bust economy. It has experienced decades of rapid, wild, exuberant growth, and then collapses. There have been at least 2 mega cycles of enormous growth, and then stagnation at best, or collapse more recently. We are in the beginning of the 3rd mega cycle for Greece, for a number of reasons. The first one, which knowing Panagiotis, he'll describe in a little bit more detail, is the starting point. Nikos has also alluded to it. The starting point implies a catch-up. And there's a lot of capital deepening that needs to happen in the next few years. And I think that I'm optimistic in that level. The second one, which is not that widely recognized, is that Greece has gone through enormous reforms, which by themselves are raising the productivity levels of the economy, underlying the growth rates. The third one, which is even less recognized, is that what I described so far as the geopolitical setup benefits Greece. Why is that? For all the reasons I mentioned earlier, Germany and the North are going to go into what a lot of you may remember, a situation like the one you had in 2002 to 2004, where the North is the patient. Low growth rates, a challenge to the business model, descaling of investment, restructuring needed that is not delivered, and so on and so forth. Slow growth at the core will imply lower interest rates than otherwise would have been needed based on what the US will do or based on what the rest of the countries will need. And it will imply looser fiscal conditions because ultimately the core will need to spend in infrastructure, in defense, in cross-European projects, etc. The fourth factor is that, and it's important to recognize this, we're going through a rapid industrial evolution with the rise of AI. I know to a lot of people this sounds like shenanigans, but the delta what's happening in the United States is enormous. And we are only 3 to 5 years away from more generalized uses of AI. That is a fundamental challenge to industrial economies and set business models. It is a better setup for economies that are more geared towards services. Services are being globalized.
Like Greece.
Like Greece. Services are becoming globalized. Human experience is irreplaceable to mechanical processes. And Greece sits at a favorable point. Now, having said all this, these are initial conditions. That's it, right? So we need to materialize that. And Greece has the potential of doing a little bit too much of something and doing a little bit too little of what needs to be done. But that's the onus of these forums. We need to gear towards an economy that is broad, towards an economy that is innovative, and towards an economy that is based on things that will not be replaced by industrial or AI-driven
So just
challenges.
to put it in Nikos' context, would you just, in a way, close your eyes, even if it's a difficult year, 2024 globally, and just say, I still need to have some allocation in Greece?
What is the alternative?
I don't know.
Money needs to go somewhere.
So Greece is a natural...
For me, it is.
Yeah, because of that long-term argument.
For
Okay.
me it is.
So Panagiotis, I'm going to give you also the pass to talk about how do you look at Greece as an market investment destination. But I want you, if possible, to put your long-term hat. You used to work for one of the canonical long-term investors, the Canadian Public Pension Fund. So if we're talking about long-term investments, this guys probably did it the best.
Yeah.
What do you do if you want to set up a fund like this in Greece, which I think Greece is about to create one, a wealth fund, and you're a long-term investor? Where do you invest in? What type of investments do you do in Greece?
Well, the mere fact that we're asking or we are thinking about setting up a sovereign wealth fund is already good news. That would have been a silly idea a few years ago. The answer has to be a mix of what Themos earlier prescribed. On the lower end of the spectrum, I would say that the process of deleveraging, the crisis that Greece went through, was extremely painful, but it killed all the dead or near dead capacity that exists in Greece. So whatever is left back is pretty resilient, is strong, and it can withstand a lot. So that's one thing. So anything really that is there now, the index, if you want, right?
Thank you for that, by the way.
That's
a paid advertisement right there.
That's the easy one. Now, Greece also, because it was left behind on many technological or even infrastructural and procedural ways of doing things, from the government to companies to individuals even, is free from the burden of legacy that a lot of other jurisdictions have. So we do not need to cater to money that we have invested over the years of doing, and we are not used to do things in a certain way, and we can jump. We have the benefit of jumping all the way to the cutting edge of today's way of doing things. And this has been done, and it has massive and profound productivity gains. So technology is something that Greece can play a significant role, and it has already been doing so. I will give you a few examples of first-hand experience that I have from people that could be anywhere in the world, yet they choose to set their home, their investment, and their technological hub in Greece, because they can find superior people, rightly priced, and that are innovative, and they think out of the box. A lot of people know that, but I will just say that Tesla's chief engineers for electric motors are both Greeks. They're Greeks that were educated in National Technical University of Athens, and they got their undergrad and their grad there. I'm pretty sure that Musk will
How do you invest in technology in Greece, you think?
Well, that needs a little bit of incubation. It's happening, I think, already, but I think that the centers of excellence that the academia, in collaboration with companies, make.
Maybe the exchange needs to do a bit more on that, right? Okay,
yeah,
give the options. Okay.
Yeah.
Well, look, on that note, I want to thank you all three. I just want to keep. I think I kept two of the promises of finishing early. I didn't get you to fight each other that much, so 2 out of 3 is not bad. Thanks, Nikos. Thanks, Themos. Thanks, Panagiotis. And I hope that you have a chance to catch up with them the rest of the day and ask them any questions you have. And I'm going to ask you to remain in the place here if you can, and I'm going to pass it on to Ms. Nikolaos for the next session. Thank you all.